expert ETF picks for 2026 with strong long-term potential. Before we start, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. In many high-net-worth households, there is a silent, growing anxiety about the 2026 tax cliff. If you are a business owner or a professional earning over $150,000, you may not realize that a critical lifeline for your retirement was just modified by the IRS. Under the latest Secure 2.0 Act regulations, high earners are now effectively barred from making pre-tax catch-up contributions to their 401k plans. Every dollar you set aside to catch up must now be on a Roth basis, meaning you are paying the tax bill today, at your highest marginal rate, rather than deferring it. For a couple in their early 60s, this isn't just a paperwork change. It is a forced liquidation of immediate cash flow that could have been used for asset-based lending or private equity opportunities. This policy shift matters because it signals a broader institutional move toward front-loading taxation. The government is hungry for revenue today, and they are getting it by targeting the most successful savers. If your portfolio is still built on the logic of 2020, you are essentially driving a car with a leak in the fuel tank. Analysts at firms like Morgan Stanley and Goldman Sachs are already forecasting a selective bull market for 2026, where the S&P 500 could reach as high as 7,800, but only if you are positioned in the right sectors. The index-only strategy that worked for the last decade is now facing the headwind of a $129 billion reduction in corporate tax benefits that is slowly expiring. To protect your wealth, you must shift from being a passive collector of stocks to an active manager of capital allocation. The solution starts with what institutional desks call the resilience matrix. Instead of just buying the market, expert analysts are pivoting towards specific ETF categories designed to thrive in a regime of moderating inflation and sustained AI-driven capital investment. The first pillar of this matrix is the quality tilt growth strategy. While the general public chases speculative AI startups, the smart money is moving into the Vanguard Growth ETF, known as VUG. With an expense ratio of just 4 basis points, this fund doesn't just hold tech, it holds the hyperscalers. We are talking about the companies expected to spend over $500 billion on AI infrastructure this year alone. By holding these cash-generative stories, you are capturing the productivity gains of the future without the valuation expansion risk of unproven companies. However, the real secret that institutional managers use, which the retail public often ignores, is the concept of factor tilting. When you look at a fund like VUG, you aren't just buying growth, you are buying profitability and low leverage. In a 2026 economy where the cost of capital remains higher than the zero-rate era, companies with clean balance sheets are the ones that will dominate. Analysts are specifically looking at the return on invested capital, or ROIC, of the top 10 holdings in these ETFs. If a company can generate 20% ROIC while their cost of debt is only 5%, they are essentially a money-printing machine. This is the difference between a speculative bet and a calculated capital allocation. The second pillar addresses the international liquidity gap. Morgan Stanley recently noted that while U.S. earnings are strong, the valuation gap between domestic and international markets is at a 20-year extreme. For a business owner looking for value-based diversification, the Vanguard FTSE Developed Markets ETF, or VA, is becoming an essential institutional bridge. It provides exposure to nearly 4,000 companies across Japan, Europe, and Canada. Analysts trust this fund because it captures the reflation trade in Japan and the manufacturing resilience in Europe that often moves inversely to U.S. tech volatility. If the U.S. dollar continues its choppy path into 2026, having this international ballast could be the single most important factor in maintaining your portfolio's purchasing power. Beyond just the valuation argument, we have to look at the dividend growth potential internationally. Many of the companies held within VA are in sectors like luxury goods, advanced robotics, and specialized pharmaceuticals. These firms are not just value plays in the traditional sense, they are global leaders with high barriers to entry. By incorporating these into your portfolio, you are engaging in a form of global liquidity management. You are ensuring that your wealth isn't tied to the political or economic whims of a single central bank. For the high net worth investor, this isn't just diversification, it is sovereign risk mitigation. The third and perhaps most critical pillar for retirees is active fixed income management. The days of set it and forget it bond ladders are over because interest rate volatility is no longer a tail risk. It is a core feature of the economy. This is why the Dimensional Core Fixed Income ETF, ticker DFCF, has become a favorite among fiduciaries. Unlike a passive bond index that might hold dead-weight debt, DFCF systematically positions its duration and credit risk to find the highest expected returns. This is essentially institutional-grade liquidity management that allows you to benefit from the Fed's pivot toward rate cuts without being wiped out if inflation proves stickier than expected. Let's look at the wealth gap math. Suppose you are 60 years old and planning to retire in 5 years. By utilizing the super catch-up provision, you can now contribute up to $35,750 to your 401k in 2026. However, since you are a high earner, that $11,250 catch-up portion must be Roth. If you simply put that money into a low-yield savings account or a high-fee mutual fund, you are losing twice. Once to the upfront tax, and once to the opportunity cost of low growth. But if you allocate those Roth dollars into a high-conviction growth vehicle like VUG, every cent of that future compounding is tax-free. You are essentially turning a tax penalty into a tax-free wealth generator. This is the type of sophisticated capital allocation that the general public often misses. Now, we must discuss the looming shadow of estate planning and the step up in basis. For many of my viewers who are business owners, your biggest asset might be your company, but your second biggest is likely your brokerage account. As we move toward 2026, the current estate tax exemptions are scheduled to sunset, potentially dropping by 50%. This means your ETF selection isn't just about growth. It is about how easily those assets can be transferred to the next generation. Using highly liquid, low-cost ETFs makes the process of valuation and distribution significantly cleaner than holding complex private placements or individual stocks with massive unrealized gains. Analysts are increasingly recommending that families use ETFs as the funding vehicle for irrevocable life insurance trusts, or ILITs, and grantor retained annuity trusts, or GRATs. By doing so, you are wrapping a high-growth engine inside a tax-shielded wrapper, ensuring that your long-term growth actually stays within your family rather than going to the Treasury. You also need to consider the small-cap alpha that analysts are calling for in 2026. As interest rates settle into a lower range, the marginal cost of doing business drops significantly for smaller companies. The iShares Core S&P Small Cap ETF, ticker IJR, is a primary tool here. Analysts prefer IJR over other small cap funds because of its profitability screen. It ensures you aren't just buying a basket of zombie companies that survived on cheap debt. Instead, you are buying a 10/10 portfolio of profitable, growing enterprises that are the most likely targets for the 20% surge in M&A activity predicted for the coming years. When a large cap company acquires a small cap company at a 40% premium, the shareholders of IJR are the ones who collect that check. This is asset-based lending in reverse. You are the one providing the equity that the big players want to buy. Let's address the psychology of the current market. Many investors feel like they have missed the boat on the recent rally. However, institutional analysts look at dry powder levels. There is currently over $6 trillion sitting in money market funds. As interest rates begin to normalize, that money will seek a home. It won't go into speculative crypto or penny stocks. It will flow into the most liquid, most trusted ETFs on the planet. This wall of cash provides a massive floor for the funds we are discussing. When you buy VUG or VA today, you are essentially front-running the trillions of dollars that will be forced back into the equity markets once cash yields drop below 4%. Furthermore, we need to talk about tax loss harvesting as a proactive strategy, not a reactive one. In a sophisticated portfolio, you should be looking for opportunities to wash your gains every single year. If you have a position in a broad market ETF that is slightly down, you can sell it to realize the loss and immediately buy a correlated but not identical ETF to maintain your market exposure. This allows you to use that loss to offset up to $3,000 of ordinary income or unlimited capital gains. This is how the wealthy stay wealthy. They treat taxes as a controllable expense rather than a fixed cost. Now, to implement this expert strategy, you must take 4 immediate action steps. First, reevaluate your catch-up strategy. Coordinate with your HR or payroll provider now to ensure your 2026 contributions are coded correctly as Roth to avoid IRS compliance risks. Second, audit your cost of ownership. If you are still holding mutual funds with expense ratios above 0.5%, you are paying a success tax to a fund manager that is likely underperforming the institutional ETFs we discussed. Swap those out for low-cost anchors like SBYM or VTI. Third, establish your income floor. Business owners and retirees should ensure they have at least 2 years of required spending in short-duration fixed income or floating-rate ETFs to insulate their lifestyle from the wide tails of market volatility. Fourth, and most importantly, review your beneficiary designations and estate structures. An ETF is only as good as the trust or account that holds it. In summary, the 2026 landscape is one of extreme selectivity. The analysts aren't just looking for growth, they are looking for quality, liquidity, and tax efficiency. By moving your portfolio into the resilience matrix, anchoring in quality growth like VUG, bridging with international value like VA, and protecting with active fixed income like DFCF, you are positioning yourself for long-term growth that the IRS cannot easily erode. You are moving from a defensive posture to an offensive one, using the new 2026 rules to your advantage rather than being a victim of them. You are applying the same rigor to your personal wealth that you would apply to a business acquisition or a major capital project. If you want to stay ahead of these high-stakes IRS updates and institutional market shifts, make sure to subscribe so you don't miss our upcoming deep dives into estate planning and advanced tax loss harvesting. Fresh videos on these subjects are uploaded regularly to ensure you have the most current data for your capital allocation. I want to hear from you. How are you adjusting your 401k strategy now that the pre-tax catch-up is being phased out for high earners? Are you leaning more into international markets or doubling down on US tech? Share your thoughts or questions in the comments below. Also, if you found this analysis valuable, please click the thumbs up button to give us a like as a thank you for this research. Finally, a quick disclaimer. I am not your financial advisor. This content is for educational and informational purposes only. Please seek professional advice from a qualified fiduciary before making any investment or tax-related decisions. The road to 2026 is paved with opportunity, but only for those who are willing to do the work and build a professional-grade plan. I look forward to helping you navigate that path in our next video.